Today, we're cracking open a fascinating piece of history, looking back, way back into the 18th century.
We are. We're looking at a man whose name basically became shorthand for incredible wealth, a real legend.
And the amazing thing is, his ideas, his secrets, you could argue they're maybe even more relevant to today's crazy markets than, some fancy algorithm.
Absolutely. We're talking about Honma Munehisa. His legacy is just enormous. I mean, it's even captured in this old folk song, about 250 years old.
That song really tells you something, doesn't it?
It does. There's this one line that always gets me. It says, we will never be like a Honma, but I would sell to become a local lord. Think about that.
Yeah, the implication is just, wow, being Honma was off the chart. So becoming a local lord,
Wow.
Living off taxes and land, that was the consolation prize.
Exactly. Munehisa, born back in 1717. This is the Edo era in Japan. He somehow managed to become wealthier than feudal lords just by trading rice. Pure skill, basically, at the Dojima rice exchange in Osaka.
They called him Dewa's Tengu. A Tengu is like this mythical creature, right? We're super powerful.
Right, symbolizing extraordinary power. And later, they just called him the god of the markets. Simple as that.
And he actually changed how people tracked markets. He gave us things we still use.
Yeah, the really tangible stuff like the Candlestick chart, Cicada's 5 methods. I mean, you learn about these in Finance 101 all over the world.
But that's almost the surface level, isn't it? The tools are one thing, but his real genius, it seems, was deeper.
Oh, much deeper. It was his grasp of human psychology, of natural cycles. That's where the real power was.
So that's our mission today. We want to get past the charts, dive into his personal writings, these manuscripts, Honma's Fountain of Gold, and the Three-Monkey Record of Money.
Yeah, pull out the core wisdom, the stuff that's kind of hidden, often really counterintuitive. Strategies about patience, timing, incredible discipline.
We're trying to sort of strip away the specifics of the 18th century rice market, if you like, and find the timeless stuff underneath.
Exactly, the behavioral science that still works. Because Munehisa's methods, they weren't really about predicting the exact price of rice tomorrow. They were about mastering your own mind as a trader.
Okay, so where do we start? Munehisa's starting point is kind of amazing for an investment guide, right? He doesn't jump into charts or numbers.
No, not at all. He starts with philosophy, almost a spiritual foundation, you could say. He makes this direct comparison. Farming and investment share the same roots.
Farming and investment, that's interesting. What's the connection there?
Well, it's crucial because it immediately takes your ego out of the equation. Think about farming. You do the work right. Prepare the soil, plant the seeds, tend the crop.
Sure, hard work.
But ultimately, you're dependent on things you just can't control. The weather, pests, call it what you will. Munehisa says it is the people who do the work. But it is the grace of heaven that makes things grow.
Ah, okay. So success isn't just about how smart you are or how hard you work on your trades. It's about being in tune with these bigger forces. Heaven, nature, the economy, whatever it is.
Precisely. If you try to force a trade against that larger cycle, you're setting yourself up to fail. It dictates the kind of mental state you need.
Which is?
He talks about needing a pure mind, and this core belief that the mind always counts more than the loss or profit.
Wow. Okay, so your mental state is more important than whether you won or lost the last trade.
Exactly. I mean, think about it. He's basically talking about cognitive bias, 250 years before behavioral economics became a thing?
Right. So if you jump into the next trade feeling angry about a loss or maybe super arrogant after a big win, that's not a pure mind.
Not at all. That's a corrupted mind. Your actions are driven by emotion then, not by, clear, detached analysis. And if that's the case, you've pretty much guaranteed you'll mess up again, no matter what the market actually does.
It's like the ultimate form of risk management then, managing yourself first.
That's it. Munehisa saw that technical mistakes. They usually follow mental mistakes. If a loss makes you angry or you feel this need to get revenge on the market.
Yeah, revenge trading. Bad news.
Terrible news. It means the real failure happened in your head long before you click sell or whatever. The loss started with the failure of mind.
And this internal discipline, this pure mind, it connects directly to how he saw the outside world working, right? This law of nature.
Yes, exactly. He's very clear.
Yeah.
The rise and fall of prices follows this fundamental law of nature. And his warning is pretty stark. He says, if you don't get this rule, if you're ignorant of it, you just shouldn't trade, period.
So what is this law of nature, more specifically?
He frames it using yin and yang. It's this deep, fundamental principle governing how prices move. He says it's like destiny. Price is destined to go down after going up to its limit, and to go up after going down to its limit.
So it's all about cycles. Things go too far one way, they have to swing back the other way, like mean reversion in modern finance terms.
Pretty much. The further it goes to an extreme, the stronger the snapback will be. When a market, doesn't matter if it's 18th century rice or, tech stocks today, goes completely wild, gets way overbought, goes parabolic, Munehisa sees that as a natural limit being hit.
And the big mistake people make is thinking, this time it's different.
Always. That's the human error. Believing that somehow the law of nature, the cycle, has been suspended just for this one magical trend. Munehisa insists, nope, the market has to pay its debt to the cycle. When it hits that limit, it must fall. Or rise if it hit the bottom.
So how does he say we should deal with this? How do we use this knowledge?
It's about perspective, about vision. He says you need to observe the rice as a whole, grasp the big picture, the grand trend. Meaning you have to consciously force yourself to ignore all the little day-to-day fluctuations, all the noise that's basically designed to confuse you, wear you out.
Right, the daily headlines, the rumors, the analyst chatter.
It's the enemy of the pure mind. If you let some small blip, some rumor, throw off your main strategy, which should be based on that law of nature, that big cycle, you've lost control. You just become part of the noise yourself instead of mastering the cycle.
That's incredibly hard to do, though, especially when everything's shouting at you minute by minute.
It takes serious discipline, which leads us nicely into his rule of three. This is all about enforcing patience and keeping that long-term vision.
Okay, the rule of three. He warns that if the beginning of a trade is bad, everything that follows will be messy, disordered.
And what's usually the bad beginning? Acting too fast. Impulsiveness.
So the rule of three combats that.
Directly. It's fascinating. He gives us very specific instruction. When you're thinking of buying or selling, you have to wait. Wait for 3 days from the very moment you first sense that profit opportunity.
3 days. So you see a perfect setup. Your instinct is screaming, go now, don't miss it. And he says, just wait for 72 hours.
Exactly. That delay, that forced pause, it makes you confront that powerful feeling, that FOMO fear of missing out, which is the total opposite of a pure mind, right?
Right. It disconnects the emotion from the action.
And you're supposed to use those 3 days actively, analyze, review the distribution condition, as he calls it, recheck the ceiling price, confirm the bottom price. It forces your rational brain to take over from your gut reaction.
Okay, but what if after 3 days you're still not sure? You still can't quite pin down that ceiling or bottom.
Then you wait longer. He says wait until you are certain, even if it takes months instead of 3 days.
Months. Wow.
That's the ultimate patience, isn't it? He argues that this kind of restraint is what prevents losses. Identifying that ceiling and bottom, that's the absolute key before you made a move.
That feels almost impossible for a modern trader, sitting on your hands for months when a signal looks good. But I guess, linking it back to the law of nature, if you can't see the ceiling and bottom clearly, you haven't really understood where you are in the cycle.
Exactly. And if you don't know where you are in the cycle, you're basically just gambling. You're trading based on hope, not on deep conviction.
Okay, so Section 1 sets up the mental game, right? The discipline, the purity of mind needed. But once you've got that calm mind, Munehisa says, it enables you to do the hardest thing of all.
Which is?
Going against the crowd. Defying the herd. This is where his contrarian strategy really kicks in.
Yes. This is summed up in that brilliant, timeless piece of advice. When people run to the west, I turn to the east.
Simple, but profound. The real opportunity is always where everyone else isn't looking.
Always in the opposite direction of that big collective rush.
But how do you know when that moment is? The moment of peak, everyone's running west. He must give some signals.
He does. Very clear ones. He says, watch for when the price is rising really fast and suddenly orders rush in from everywhere all at once. You see this buying frenzy everyone desperately wants in.
That feeling of, I gotta buy, everyone else is buying, it's going to the moon.
That exact feeling. When you feel that irresistible urge to pile in just like everybody else, Munehisa says, that's precisely when it is important to be on the side of those who place sell orders.
So you look for peak euphoria, that moment when the buying feels unstoppable.
Yes, that intense, focused, unanimous rush, that feeling of infinite momentum. That's usually the market sucking in the very last buyer. It's exhausting itself. He uses this amazing image.
What's that?
He describes the market price surging as if rice bags are flying through the air.
Wow, what a picture. Like, it's totally detached from reality, weightless, irrational momentum, no connection to actual supply or demand anymore.
Exactly. Pure emotion driving it.
Yeah.
And he says this kind of explosive move, it sneaks up on you from behind while 10 out of 10 people are facing one direction.
Meaning the reversal hits when everyone's convinced the trend will just keep going forever. They're looking straight ahead, totally blindsided when the market turns and hits them from behind.
Right. It demands this radical ability to stay mentally separate from what the crowd is feeling.
And this same logic, this counterintuitive thinking, it applies at the bottom too, right? In those awful, drawn-out bear markets.
Absolutely. What he calls buying when weighed down.
Mhm.
Prices just keep dripping lower, terrible rumors are flying, the market feels completely dead, everybody agrees it's a disaster zone.
And that universal agreement, that feeling of total despair in the air.
That's the signal.
Yeah.
He says when you yourself finally agree, yep, it certainly is a bear market.
Yeah.
That's the exact time you need to start buying, and with renewed determination.
Man, that takes guts. Buying when everything feels hopeless.
It's emotionally brutal. He even acknowledges it. He says, buying then might feel like jumping into the ocean and not something likely to bring about success. It feels completely wrong.
But that feeling, that's the key.
That difficult, isolating, counterintuitive moment, the moment. That's when you have to buy, without hesitation, for what he calls a sure profit, because the price has gotten so disconnected from any real value just because of the overwhelming fear.
So you have to embrace being uncomfortable, being alone in your view.
Yes. And he adds another layer. If you expected the price to go down, and it does, and the market feels really sluggish and awful, he actually advises you to just sit tight then. Ignore the market.
Why ignore it if it's doing what you thought?
Because, he says, the rally that eventually comes after that despair phase, it'll be so fast, so sudden, so unexpected by the fearful masses that your own mind will struggle to keep up if you're trying to trade the small wiggles down.
Ah, I see. You buy at the point of maximum despair and then hold on.
Exactly. The secret is that the emotional difficulty, that uncertainty you feel buying at the bottom, it's the mirror image of the profitable uncertainty the contrarian feels when they're selling at the absolute top. It's the same feeling, just inverted.
Okay, this is getting really deep into the psychology. Now, he takes it even further, right? Moving beyond just reading the crowd's mind to actually doubting your own mind.
Yes, this is the rule of changing your mind. He calls it a profound secret, and it's mind-bending.
Lay it on us.
It's basically institutionalized self-doubt. He says, when your own inner voice, remember, this is the disciplined, pure mind you've hopefully cultivated, when that voice tells you very clearly, the rice price is sure to go up, I must buy it today. What do?
You buy. With conviction.
No, you wait 2 days, and then you change your thinking and sell.
Wait, what? So I finally achieve this pure mind, I do my analysis, I get this moment of clarity and conviction, and that's the signal to do the exact opposite.
Bizarre, isn't it?
It feels like it would create total paralysis. If my own best judgment is inherently timed wrong, how can I ever trust my analysis?
That's the razor's edge he's walking. It's a massive challenge he presents. He's not saying your analysis is necessarily wrong. He's saying the timing of your peak emotional conviction is wrong.
Why?
Because your emotions, even your highly trained ones, are still, in some way, reflecting the collective. His rationale is explicit. When you are optimistic, all others are optimistic. When you are pessimistic, all others are pessimistic too.
Okay, so that final surge of, aha, I've got it, I must act now. That feeling means the signal has become so blindingly obvious that pretty much every other smart person in the market has reached the same conclusion at the same time.
Precisely. Your personal aha moment is actually a lagging indicator of market consensus. And the universally obvious trade. It's almost always too late. Or worse, it's the setup for the reversal.
So the profitable move is to fade that feeling, to move against that universal certainty, even when it feels right internally.
Correct. If the market looks terrifyingly bearish and your analysis screams, sell, get out,
Yeah.
you wait 3 days, and then you decide to buy instead. Success comes from opposing the collective and realizing your own peak conviction is often the signal that the collective has reached its limit.
Right, we've got the mindset, the contrarian plays. But Munehisa wasn't just a psychologist, was he? He was grounded in the fundamentals of his market.
Oh, absolutely. He hammers this point home. Crop harvest appraisal is the fundamental basis of the market price. You can't ignore the real-world supply.
Which is important because we need to remember what the Dojima exchange was. It wasn't just bags of rice changing hands.
No, not at all. It was incredibly sophisticated. It was effectively the world's first formal futures market. They were trading standardized contracts, derivatives, centuries ago. To win there, you needed serious macro-level research.
And for Munehisa, that meant understanding supply deeply.
Deeply. He talks about how complex it was just forecasting the harvest in 18th century Japan. He lists all these different regions, Kyushu, Shikoku, Chugoku, Kinai, Tokaido, Oshu, and points out that even with similar weather, the results could vary hugely from place to place.
So a trader had to be like a modern analyst, gathering all this regional data, trying to piece together the big picture of national supply.
Exactly. Aggregating and interpreting data. The timeless lesson there is pretty simple, really. Never let market sentiment, the stories and feelings, completely override the physical reality of supply and demand.
And he actually formalized this into predictable patterns, right? Based on the seasons using the lunar calendar.
Yes. He identified these expected cycles. Having this baseline gave him an edge, a framework for anticipating likely moves.
Can you walk us through some of those? What were the typical arcs he saw?
Sure. He noticed, for instance, that the price often hit a floor and stayed there, stagnated, from winter through to about lunar February. Kind of a dead period before the new growing season really kicked off.
Okay, makes sense. Old supplies, maybe dwindling, new supply uncertain.
Right. But then he said it was certain to rise, starting around March or April, and that rise would usually continue into May or June, a predictable pre-harvest squeeze.
Interesting. Certain to rise. Pretty confident.
He was, based on his observations over years. And he had these conditional rules, too. It wasn't just, it always rises then.
What?
Like, if the price had really scraped the bottom back in winter, say lunar January, then it was likely to rise strongly into May, June. But conversely, if the market had somehow managed to hit a ceiling price really early, like Jan-Feb, maybe due to some weird supply shock or something, then the price was actually likely to go down in May, June, as that early pressure faded. So the outlook for spring depended heavily on what happened in the winter.
So his rules adapted to the preceding market action. They weren't just rigid calendar dates.
Exactly. Dynamic. Now, his prediction for June is particularly interesting because it sounds so absolute.
What did he say about June?
He said, if the price falls enough in May, it makes a sharp increase in June. Okay, that makes sense. A bounce. But then, if it doesn't plunge in May, it will definitely crash in June. Do not doubt this.
Wow. Definitely crash. Do not doubt this. That's emphatic.
It is. It suggests he observed this recurring pattern where if the market sort of delayed a necessary price adjustment in the spring, the correction in June, when it finally came, was really violent, like stored energy being released.
And looking towards the end of the year, around harvest time.
He said if the price peak hit the ceiling sometime between July and October, right in the main harvest period, then it was most likely to decrease until December, then after.
Which makes sense, too. A harvest time peak probably isn't sustainable once all the new supply actually hits the market.
Right, the fundamentals reassert themselves. Now, how did he trade based on these harvest conditions? He had clear rules for that, too. Basically, buy fear, sell certainty.
Okay, explain.
If the summer weather was bad, cool, rainy, lots of insects, floods, storms, all clear signs pointing to a poor harvest.
Right, fear of scarcity would be building.
Exactly. So that's when you must start buying, especially when the price is weak. You're buying into that fear, anticipating the almost guaranteed supply shock that's coming.
And the opposite, good weather.
If the weather looked good in June and July, lots of sun, pointing towards a bumper crop, don't rush to buy right away, even though a good harvest seems likely.
Why not?
He said, wait, August and September? That's the time to buy. He claimed that even in a fantastic harvest year, the price always starts to rise in September and October. Maybe it's storage costs, maybe institutional buying patterns, who knows. But he saw it consistently.
So wait for the good news to be fully priced in, maybe even overdone. Then look for the seasonal turn.
Sort of. But the most important message through all these seasonal specifics is about bias. He absolutely demanded that when the new crops started coming in, you had to let go of any preconceptions you had developed in the previous year.
Forget last year's patterns.
Completely. The market only cares about this moment, this year's harvest reality, this year's supply, this year's atmosphere. Your success last year doesn't matter. It can actually blind you if you let it. Focus only on the now.
Okay, we've got the mindset, the contrarian thinking, the fundamental grounding in supply cycles. Now, Munehisa gets into the nuts and bolts, right? How do you actually execute trades based on all this without blowing yourself up?
Exactly. This is where his famous 3 methods come into play operationally. They're largely about how to respond, how to be nimble when the market starts moving really fast, gets volatile.
Now, this part can be a bit tricky for modern readers, I think. The context is very specific to Dojima.
It is. We need to be clear. He's talking about trading rice contracts measured in a unit called the koku. So when he mentions price points like 2.3 koku or 3 koku, he's talking about the value of that specific futures contract.
Got it. So let's try to break down that complex example he gives for trading during stagnation. It seems to be all about identifying when the weak traders, the weak hands, finally get flushed out.
That's exactly what it's about. Okay, so here's the scenario he lays out. First, you have a good, strong rally. Price goes up, 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 and hits a clear ceiling level. Let's use his number, say 2.3 koku.
Okay, rally hits resistance.
Right. Then the trend pauses. It might even nudge a little higher, maybe to 3.2 or 3.3 koku. But the key thing is it then starts to fall back, down towards the 3 koku level.
And what happens at 3 koku?
People rush in to buy. Why? Because they remember that earlier strong rally up to 2.3. They see this dip back to 3 as a buying opportunity.
Buy the dip.
Makes sense. Classic pattern. But Munehisa says, this buying is a trap. It lacks genuine force. It's driven by memory, by hope, not by real conviction. And because there's no real power behind that buying,
The price doesn't hold.
exactly, it tumbles much further than anyone expected. It plunges down to maybe 5 or even 6 koku, and all those people who just bought the dip at 3, they get stopped out, they panic sell, the weak hands are flushed out.
Ah, the shakeout.
Precisely. And that steep, scary plunge, the one fueled by panic from the failed buy the dip signal, that is the genuine opportunity Munehisa wants you to catch.
So you buy when it hits 5 or 6 koku, when everyone else is selling in despair.
That's what he says. That's the true time to buy. Why? Because he believed the price was then almost certain to snap back up to that 3 koku level.
Why 3 koku specifically?
Because that 3 koku level was the most significant price point during that initial sideways period, that stagnation, before the failed rally and the subsequent shakeout. It was the market's sort of equilibrium point before things got crazy.
Okay, so the lesson isn't really about the specific numbers, 2.3 or 3 or 5. It's about the sequence.
It's the psychological sequence. False move lures in the weak traders. Then a sharp collapse cleans them out. The real reversal happens right after that cleansing, and the price tends to snap back to the last significant point of stability.
So it's patience during volatility. Let the market fool the impulsive crowd first, then step in after the emotional dust settles.
Exactly. The 3 methods were essentially his tools for telling the difference between those false signals and the real turning points.
Okay, moving from executing a trade to managing yourself. His rules on capital management are incredibly strict, aren't they?
Oh yeah. Rule number 1 is pre-commitment. Before you even think about trading, you must decide very clearly where your capital is coming from and exactly how much you're willing to risk. Full stop.
Know your absolute limit before the market starts messing with your head.
Right. It builds a firewall, protects you from ruin. And then when it comes to actually buying, he says don't go all in at once.
Staggered buying. Scaling in.
Yes. Start small. Buy in small quantities. Only increase your position size if, and only if, the trade is already making you money. You only add risk using your profits, never by adding more of your initial stake.
Leveraging winnings, not leveraging initial capital. Makes sense.
Then comes what you could call the ceiling on greed. This one is really profound.
What is it?
He says. You must stop trading once you've deployed the total amount of capital you originally planned to risk on that idea. Stop. Even if the price keeps going in your favor after you're fully invested.
Wait, stop trading even if it looks like there's more profit to be made. Why limit your upside like that?
Because overconfidence is lethal. Getting a few easy wins makes you feel invincible. That's when you make a stupid, oversized bet that wipes you out. Putting a hard cap on your deployed capital prevents that ego-driven disaster.
It's about protecting yourself from yourself, again.
Always. And managing expectations. He advises, be mentally prepared to take, say, 500 koku of profit when maybe you could have squeezed out 1,000. Take 50 when you could have gotten 100.
Aim for good, not perfect.
Exactly. Deliberately capping your greed prevents you from chasing that very last tick, trading recklessly right at the absolute top or bottom. If you always chase the maximum possible profit, eventually you end up making no profit at all, or worse.
Okay, and this leads to what I think might be his most demanding rule. The one that modern finance would just laugh at.
Ah, you mean the break?
The critical importance of the break, yeah.
It's amazing, isn't it? He says, after you close out a successful trade, a profitable deal, you must take a break. A mandatory break. for 40 to 50 days.
40 to 50 days. Off. After a win.
He warns, in no uncertain terms, if you forget this break, even after making good money, you are almost sure to give it all back and more. Why? Unchecked greed and the overconfidence that comes from winning.
Can you imagine telling a hedge fund manager today, great quarter, now take the next 6 weeks off?
Right. It just wouldn't happen.
Yeah.
That rule alone tells you how central mental discipline, resetting your emotional state, was to Munehisa's entire approach.
And it's not just sitting around doing nothing for 40 days, is it?
No, it's not idleness. The purpose in the break is to keep watching the market, but with a calm mind. Use the time off to reevaluate everything, the supply situation, whether the 3 methods are still working, but do it without the pressure of having your money on the line. It's a forced recalibration period.
Like letting the mental dust settle.
Exactly. And the rule applies if you make a mistake too. If you realize you made a wrong decision, get out fast, sell the position, take the loss, and then
Take the 40, 50-day break.
take the break immediately. That stops the downward spiral. It prevents the revenge trading, the desperate attempt to win it back quick that destroys accounts. Always reset the mind before you re-engage.
So as we get to Munehisa's final teachings, it feels like the focus shifts almost entirely away from market specifics and onto, well, character, really. Emotional control, the long game.
Absolutely. His first command here is purely about emotional discipline. It's stark. You should never sell or buy because you're angry.
Simple, direct. All emotional triggers are just noise, distortion.
They are. And he talks about regret, distinguishing between 2 types. This is insightful.
Okay.
He contrasts what he calls laughable regret with serious regret. Laughable regret is missing out on a small profit, maybe 20–30%, because you were patient and waited, like the rules say. You should just shrug that off, forget it instantly.
Right. That's just the cost of being disciplined.
Exactly. But serious regret, that's losing everything, missing out on a potential 70–80% gain because your greed made you rush in at the wrong time and you ended up taking a big loss instead.
So the first kind of regret is acceptable, part of the
Right.
process. The second kind is a sign of failure, a failure of character.
Precisely. It shows a fundamental lack of discipline, which feeds directly into his demand for consistency. He says, be consistent. When you decide to buy or sell based on your analysis, stick with it. Don't keep changing your mind because of every little market wiggle.
And if you're genuinely unsure,
Wait. If you're unsure, wait for several months if necessary. That's the kind of patience that allowed him to capture those huge multi-month or multi-year cycles instead of just chasing tiny short-term gains.
this whole philosophy seems to lead to trading less, not more.
Much less. He's explicit about it. Trading all the time throughout the year actually brings less winning. The really good opportunities, the ones that can genuinely change your wealth, they only come maybe twice a year.
Twice a year. That's incredibly infrequent by today's standards.
It's radically low frequency.
Yeah.
And it directly contradicts pretty much every incentive structure in the modern financial world, which thrives on activity, on turnover. Munehisa insists, do not trade based on daily fluctuations. Only make your move when you are absolutely certain about the timing, and that certainty only comes after watching, studying, waiting for days, weeks, or even months.
He really frames trading as this incredibly serious, high-stakes undertaking, not a game.
Definitely not a game. He warns, don't ever start trading just as a pastime, as a hobby. If you treat it lightly, your beginning is bad. And that light approach leads straight into that cycle of regret buying and regret selling, constantly reacting emotionally, chasing small losses with impulsive moves.
And he uses an analogy to drive home the seriousness,
He
right?
does. He compares rice trading directly to military art or military strategy. He even referenced classic Chinese texts on warfare, like the 3 military strategies and 6 secret teachings and the 8 formations.
So market maneuvers are like deploying troops. Wow.
Yeah, he treated it with that level of gravity. It highlights the need for planning, for preparedness, for building a strong defense that's your capital management. And it acknowledges the hard truth. Just like in war, you cannot win every single battle.
So while his 3 methods needed some flexibility, unlike rigid military rules perhaps, the underlying discipline required was on par with a general planning a campaign.
That's the level of seriousness he demanded. And then we get to the very last instruction, the absolute final word in his writings. And it's a bit chilling.
Which is?
The strict rule of secrecy. He says point blank, this writing you should never show to anybody no matter how close they are to you. Keep it secret.
Why so secretive? Was it just about keeping the golden goose for himself?
He actually gives a reason, and it's not just about being the only rich guy. He explains that these methods, this wisdom, could be easily misunderstood or misused by people who lack the necessary discipline.
Ah, so it could actually cause them harm.
Yes, financial damage. And he even worries it could create hostility against us, perhaps if people lost money trying to apply the method superficially, and then blamed him or his students. It's a powerful knowledge, a weapon in a sense, and dangerous in untrained hands.
So protect the knowledge from those who aren't ready for it.
And protect yourself from the consequences of their misuse. And his final operational secret, the grand secret, kind of loops back to this mental isolation.
What's the grand secret?
He tells his student, listen to everything. Absorb all the news, what's happening in Kyushu and Osaka, the harvest reports, take it all in. But crucially, never tell others what is in your mind.
Keep your analysis totally private.
Totally internal. Protect your pure mind. Don't let external opinions, chatter, sentiment contaminate your own hard-won analysis. Stay isolated in your thinking. Hashtag tag outro.
Okay, so distilling all this down. What Honma Munehisa seems to be telling us across centuries is pretty clear, isn't it? Success in trading, real success, it's less about some magic formula or prediction.
Much less. And far more about things like patience, incredible patience, timing that often feels completely wrong, counterintuitive, extreme discipline over your capital, and maybe most importantly, over your own emotions.
Yeah, conquering your own greed and fear seems paramount. Yeah. Letting go of the ego.
And his whole system, whether it's the 3 methods or that crazy 40-day mandatory break, it all seems rooted in understanding natural cycles, that law of nature, the yin and yang. It's about recognizing when the collective human emotion, the market sentiment, has swung too far one way.
Recognizing peak optimism or peak pessimism. That seems to be his master key, doesn't it? That's the signal for a potential reversal you can profit from.
It really does. Which brings us to our final thought for you, the listener. Something to chew on.
Munehisa made this fascinating observation. He said that the absolute peak, the ceiling price, is reached right at the moment when the rally stalls, and nobody can tell if it is going to go up further or down.
Think about that moment. It's not peak confidence anymore. It's peak uncertainty. Consensus is totally broken down. Even the experts are scratching their heads, paralyzed. Up or down, nobody knows.
So if Munehisa is right, if the ultimate skill is identifying that specific moment of maximum confusion, maximum doubt,
how can we train ourselves to recognize that today? In our own markets, our own investments. It's not a number on a chart, is it? It's a feeling of universal, paralyzing uncertainty.
How do you spot the moment when everyone else is lost? That, according to Munehisa, might just be the moment of destiny.
Something to definitely mull over as you watch the markets.
Indeed, until our next deep dive.